I'd like to hear what your opinion is about the Federal Reserve, because that obviously impacts some of the things that we do. When I'm talking to my clients on a daily basis, I don't think that they necessarily quite understand what the Federal Reserve does and how that might impact them. They're like, hey, I heard the Federal Reserve is going to cut rates and that's going to directly impact mortgage rates. Or they cut their rates 0.25% and then our rates, mortgage rates will drop 0.25%. That's not really how it works. But they have a meeting, I think it's in 10 days, 2 weeks, and they cut interest rates today. So what do you...
It's our backstop.
Did they do the right thing?
Yeah, it's the Fed will always be the backstop to this. That kind of gives us a little bit of comfort, right? So when you see a crisis, granted it's a biological crisis, it's not a financial crisis by any stretch, but when you see a crisis come into play and you see panic come into the market, we view it as opportunity at some point. And we know from past experiences, the financial crisis of 2008 and 9, the Fed is kind of the backstop. I mean, the Fed's going to come in there and do what they got to do, in this case, cut rates, to keep all the liquidity in the market, right? They're going to, so I see that as a positive. You're right. This was very unusual for the Fed to come out today, before their meeting, to cut rates. And I think that shows you the concern they have for the panic in the market relating to the coronavirus. Not only that, I think at the June meeting and the November meeting, I think there's greater than 50% probabilities that they're going to cut more. So I think you'll see the Fed continue to cut rates throughout the year. I think you'll see the Fed expand their balance sheet to keep on buying mortgage-backed securities, to keep all the liquidity in the market. And quite frankly, you're going to see President Trump step in at some point and tax cuts or do whatever he needs to do to keep the positive momentum in the markets. So these were all good things.
So as far as mortgage rates, as you mentioned, that's going to help. We're getting the Fed cuts rates, but they're doing much more than that. They're buying treasuries, they're buying mortgage-backed securities, because where interest rates are right now, this is not a normal level. They are much lower since we're at near historic lows. So how does that necessarily impact us and on the mortgage side as far as a business and industry and as far as consumers? I mean, is this, it sounds like this is going to be beneficial for everybody.
Absolutely. As rates go, so does production. The old saying. As rates go down, there's an inverse relationship to production. Production goes up. You're correct. Yesterday we had a record low in the 10-year Treasury. I believe it got to a 103 yesterday. Mortgage rates are at 8-year lows. But the biggest question I get is how come mortgage rates aren't moving lower as fast as Treasury rates are? Right? You hear that all the time. And I think it's 3 reasons, quite frankly. I think one, when you have panic in the market, there is no substitute for the U.S. Treasury. I mean, people want to buy the treasuries. They don't want mortgage-backed securities. They don't want corporate debt. They don't want municipal bonds. They want the U.S. Treasury. So the treasuries are being bought at a pace that's unheard of around the world because there's panic in the markets. So that is driving treasury rates lower than mortgage rates. And secondly, if you think about it, what happens when rates go lower? Well, people are going to refi their mortgages. And what happens to mortgage-backed securities when people refi their mortgages? It's a phenomenon called negative convexity. In other words, at some point, the lower the rates go, mortgage-backed securities become worth less money because people are refining and the prepayment speeds are going so crazy on the mortgage-backed securities that people say, I don't think so. In fact, if you look at some of the big portfolio players in the mortgage-backed security market, they are also recognizing that risk. And what are they doing? They're hedging with U.S. Treasuries. Yep. So that, again, is causing the rates or the spread between Treasuries and mortgage rates continue to widen out. And thirdly, it's kind of I think it's what I feel. It's more of there's a point at which lenders aren't going to lend 30-year fixed rate money below a certain rate. I think me and you both saw back in 2008, 2009, I think the lowest rate I saw during that financial crisis was 2 7/8 on the 30-year Fannie. Mm-hmm. And it only lasted for a few weeks. Mm-hmm. So I do believe lenders are saying, you know what, this is about as low as I'm going to go. I'm not going to go much lower than this. So even if treasuries continue to go down, I think me and you are in the same court. Who knows? I mean, you'll probably see a 1-year, 10-year treasury or lower. Most countries around the world, as you know, have negative interest rates. I think Germany, for the first time ever, got negative rates across the board. We're not there yet. Again, that's why global money is coming into the U.S., because at least they're getting something on their money.
And it's still just remarkable how negative interest rates and all this gets connected. So if other parts of the world's going down, eventually our rates will be pulled down as well, just because the money's going to flow over here because you get some sort of rate of return. Yep. I wish I could have you in front of my clients sometimes explaining that, because they're always saying, hey, I'm watching the news and the media always talks about, even this morning watching the news, they were talking about the 10-year treasury, and they said, oh, your mortgage rate is tied directly to the 10-year treasury. That's not actually correct, because like you were just saying, you actually have a disconnect at some point where the treasury might go down, but there's a certain level where you just can't lend the money on mortgages where there's just no money there, there's no profitability, and it gets difficult, and trying to go down that next level just gets that much more challenging as we get this low. And I think a lot of people don't understand just how low this really is for the cost of money.
Absolutely, because you got to remember, if we're lending at 2 7/8, you know, my cost of funds is going to be around 2 1/4, mm-hmm. 2, which is very good. So when you see these rates continue to go down, as with banks, margin compression, mm-hmm. It gets tighter and tighter and tighter. So yeah, it's very difficult, and that's why I believe you will always have a floor in mortgage rates, because you're always going to have a cost of funds. Mm-hmm. I don't think we'll see negative rates in the U.S. I can't imagine a scenario where you're going to give me money to go borrow some money. That'd be nice, wouldn't it?
Yeah, well, that'd be awesome. I get that asked every now and then. Hey, I'm going to buy a house. When are you going to pay me to make money?
Yeah. Me and you may go borrow $1 trillion. Be fun.
Yeah. Yeah.